So the Royal Commission. The day after the Royal Commission was released, the bank's profits jumped. Right? So this tells us that the banks were let off. I'm sure you all heard really terrible things during the Royal Commission. We heard stories about people selling insurance to people with Down syndrome. We heard collecting fees for no service. We heard about life insurance premiums being deducted from the estates of people who are not alive. And we also heard Commonwealth Bank systematically allowing the laundering of millions and millions of dollars through their smart ATMs and not referring it to the relevant authority to bring it to their attention. Almost certainly was used by terrorists and drug syndicates. But they got let off the hook. Their price shares went up, whereas mortgage brokers screwed. Right? Mortgage Choice and AFG down nearly 30%. Our business model is effectively smashed. So my assumption is we must have been exponentially worse than the banks, right? For us to be out of business and for them to have made money, we must have been baby killers, you know, in what we did. And so I challenge people and I say, all right, well, if this is the case, you were so easy to rattle off all those bad things that the banks did, start rattling off all the bad things that the brokers did. There's silence. No one can think of a single instance during the Royal Commission that mortgage brokers did the seriously criminal stuff that the banks did. There were a couple of instances in there, and those brokers should be put in jail and definitely not allowed to practice in our industry. But it seems a little bit unfair that we've been targeted when we write 60% of the loans and account for less than 0.5% of all of the complaints. Your Royal Commission, Mr. and Mrs. Taxpayer, made 76 recommendations and cost $1 billion. That's $13 million per recommendation. And it came up with some absolute doozies like this one. Recommendation 5.6, all financial service entities must assess their culture and governances, identify problems and deal with them. What does that even mean? It is so wishy-washy. Is that really worth $13 million? Are you proud that your taxpayer money went towards a recommendation like this? It gets better. There's the ones relating to mortgage brokers. Mortgage brokers must act in their clients' best interests. I think we're doing that, right? And if this recommendation that from now I have to tick a box to say I'm acting in my client's best interests, easy, simple, because we're already doing it. Right? Was that really worth $13 million, this recommendation right here? Yeah. But the big one is this one here, which is to ban commissions to brokers. So over a period of 1 to 3 years, the Commissioner recommends that all commissions be banned so that banks are not allowed to pay us for the introducer's fee. What that means is that you as the borrower will need to pay us. That fee would be between $3,000 and $5,000. So every time that you borrow money, you would need to pay me $3,000 to $5,000 for me to act on your behalf. That will simply kill the mortgage broking industry because so many people, as much as they love me and the work that I do for them, they are not going to spend $3,000 to $5,000 on something that for the last 30 years has cost them nothing. Right? So that will just drive massive amounts of traffic back to the banks that have the big branches and away from mortgage brokers. And the Commissioner understood this. And what he said was, well, that's going to create an unfair, unlevel playing field. So what we're going to do now is if you want to borrow money, whether you use a mortgage broker or go direct to the bank, you have to pay that fee, right? So the person this really affects the worst is the one who's never used a mortgage broker and never intends to. In the past, they would always go to their local branch and they would get their loan. It didn't really cost them anything. But now, that person is going to have to pay between $3,000 and $5,000 to get a loan directly from the bank. So every time you borrow money, every time you refinance, if you sell your house and buy another one, $3,000 to $5,000, whether you use me or walk into the branch. And this is what's known as the Netherlands model. In the Netherlands, they have this system, no commission, and they have a universal fee that everybody pays regardless of the channel that they use. The borrowers pay the bank or the broker, and it's between €2,000 and €3,000, and it's called a mortgage arrangement fee. However, there's major differences, which means that this scenario will never ever work in the Australian setting. For example, in the Netherlands, you can borrow 101% of the value of the property. So you can actually borrow the mortgage arrangement fee on top of the purchase price. So no money down to purchase a property. There's no stamp duty in the Netherlands. Lender's mortgage insurance is optional. You can choose to take it out if you want to. If you do take it out, your interest rate goes down a little bit, but it's completely up to you whether you insure your own loan or not. And to get this, owner-occupied home loans in the Netherlands is tax deductible, right? So the mortgage arrangement fee, any kind of associated purchase cost, and most importantly, the interest that you pay on your home loan can be claimed as a tax deduction against your income. Can you imagine this happening in Australia? Can you imagine the state saying, look, we don't need stamp duty anymore? I mean, the only reason the New South Wales economy is in the black is because of stamp duty. Can you imagine the bank saying, yeah, look, borrow 95% of the value of the property and take out lender's mortgage insurance if you want to? We're a nation of tight asses. No one's going to take out that insurance. And most importantly, can you imagine any party extending negative gearing to, the majority of people in this country who have home loans and are paying interest on it? So this scenario simply will not work in the Australian setting. It is comparing apples with oranges, sorry. So the consequences of the Royal Commission, if these recommendations are implemented: big bank profits. So the mortgage sector, just heaps of brokers will leave the industry. That will drive business to the big banks. It'll drive business away from the little banks who rely on mortgage brokers to be their distribution channel. There'll be reduced competition. In fact, in Netherlands, the number of lending institutions since this reform was put in place has dropped from 99 to 44 lenders. There'll be reduced access, especially for people in regional areas where there aren't any branches close by. Brokers have been a source of information and access for them. Lending will become more expensive by at least $3,000 to $5,000. Credit damage. So one of the main things that we as brokers do is we don't recommend lenders that have no chance of approving your loan. Right? If you put in applications that get declined, how does that benefit anyone? Doesn't benefit you, doesn't benefit me. Every time you apply for a loan, it shows up as a credit inquiry on your file. The more credit inquiries you have, the worse your credit score becomes. So without brokers telling the clients what different policies the banks have and which policies and which banks suit that particular client's needs, people are going to be putting in applications at their local branch, getting declined, moving to the next one, doing the same, moving to the next one, doing the same, and that's going to hurt their credit rating. Real estate values would be affected. There are, this will prevent more first home buyers from getting into the market. It'll prevent people from buying and selling if it costs so much to borrow. But the big one is the reverse loyalty program. So the banks know that as an existing customer, they don't have to look after you as much as they do new customers. So when you're with a bank, they will gradually increase your interest rate while offering the very lowest interest rate to new customers. It is a reverse loyalty program. And this would make that even worse, because currently the barrier to refinancing to get a better deal is the hassle involved. It's not the cost, it's the hassle. Well, now it's going to be the hassle and a $3,000 to $5,000 cost. And the banks are going to know that. They're going to know that once you're with this bank, you're not going to change because it's going to cost you $3,000 to $5,000 to change. Labor actually introduced, they banned the charging of deferred establishment fees in 2011. So this was a barrier for people to refinance because the banks were able to charge you a significant fee if you paid the loan out in the first 4 years. Labor got rid of that to improve competition. Now they're proposing to put it back in again, but probably triple the amount that it used to be. So a possible solution, first of all, I don't think that the current system is broken. I mean, clearly it's not. We write 60